India is an alpha generating market, a market which is growing with the kind of GDP growth we have, and the investors also look at India for alpha generation. The pressure is high on you, right? There was a time when MSCI index was the best benchmark to have because you could beat it left, right, and center. You wake up in the morning, you're beaten MSCI index. You didn't have to do much. Things have changed in the last 3 years. Someone's doing a great job in that index because the index is started performing pretty well. The question then begs is active versus passive, because I have seen that for a global investor who's probably looking to invest in India, the go-to is, let me buy an ETF. I'll just quickly buy it, can get an allocation, I'll get going, get comfortable, and then add. How is the pressure, A, of delivering alpha? And what is the message you want to give to investors that India still remains an active manager's domain and alpha generation will happen over the next decade? We've got everyone spoken at length about the golden decade. So it's given that, yeah, next 8-10 years is going to be fantastic. But as a manager, what is the pressure on us to deliver that alpha? And obviously, when I say us, it's on you, not on me. Luckily, I don't need to deal with that. And also, would it be appropriate to say that even today, India is and will for a foreseeable future be an active manager's domain? You can have everyone's views.
So I think when we look at it from our lens, what we clearly see is, yes, there is an immense pressure to generate alpha. But if you are more clear about how you want to generate that alpha, then I think that brings a lot of clarity amongst that pressure that we face. When we compare passives versus actives, I think our sense is passive is more backward looking in terms of the way the investment is done, while active is more forward looking. So when we look at a country like India, where it's a young country, things are changing very fast, you have policy which is changing very fast, taste and preferences are evolving rapidly. I think active clearly has an edge because it allows you to enter into themes, sectors at a very early stage, thereby letting you capture the large part of re-rating before these respective companies be a part of the indices, and then it gets into the passive zone. So I think the first leg of re-rating, which is discovery of these businesses and the way the structural changes are happening in the economy and how to best capture them, I think actives clearly have an edge to that extent to capture the first bit of large re-rating that happens.
Sure. Just to quickly add on to what Chetan said. So yes, there is pressure, but that is a pressure which we enjoy. Right? There is good pressure and there is bad pressure.
You know whom to call when next time we don't perform.
We are in this business because we like this pressure. One other aspect is, if we are, during short periods of time or during specific periods of time, it is quite possible that passives could outperform actives. But the way we do our stock selection and the way our process works, so there are roughly 5,000 odd listed companies in India today. We at ASK at any point of time are evaluating less than 5% of that. So that is 250. Like any large data set, one can make a normal curve. And what we are looking at is only the extreme right side of the normal curve, which is the best in class in terms of growth and the best in class in terms of quality. And what we would expect is that those businesses, because they are run by managements that have ambition, vision, and a track record of execution, they would be able to capture a larger part, a disproportionate piece of the India opportunity. And hence, that should enable us to outperform the indices and the passives over a longer time horizon.
I'll just add on to what Sandip said, and he rightly said that this is a pressure we enjoy. Because investing is something where we need to love what we are doing. It's not a 9-to-5 job. It's something that has to come from within, right? And I really believe the entire team actually really love what they do day in, day out, meet corporates, understand trends, not short term, more longer term trends, because these are discussions that we engage ourselves in, day out, right? So it has to come out of the passion of doing what you are doing. Coming to the part of India as an alpha market, I really believe that if we keep doing right things, if we keep minimizing errors of commissions, long period returns are derivative and they will in general be positive. Right? So we have to be sticking to our core, focus on right businesses, minimize errors of commission, and obviously there can't be grave error of omission as well. Given the fact that India is a market where there are a lot of opportunities that keep coming up, right? There will certainly be errors of omission. Right? The whole idea is to minimize errors of omission can't be grave, and minimize error of commission. I think our job is done.